my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. Chicago soybeans. 21 weeks ago and at every opportunity since, I said here, and I quote, "The only other thing to bear in mind is not here on this daily chart but in Chicago soybean meal." And that is the well highlighted annual key reversal down we saw there for 2023. Not directly related here, but not worth ignoring either. End of quote. Now, I know I sound boring, but this is important. I feel I must keep repeating this point such that in all things this year and going forward should be seen in the shadow of this pattern. Okay, so from the May double top, we have seen prices head lower at the start of June and thereafter. 11 weeks ago, I added, and I quote, "I've drawn a new, small, recent, bright red highlighted bearish Andrews pitchfork for the action during May. It is a nascent pitchfork, but I've decided to place it in anticipation of a possible move lower." End of quote. Until mid-July, I had really nothing more to add to this pattern. It was not perfect, but it worked well until the changeover gap. And I've been still minded to keep it on my daily chart to help show the bearish angle of attack. We are right now below the lower time, currently at 981, using it actually as resistance today. I've been hugging this bright red lower time more or less since prices dropped below it. Anyway, the move lower since the break has been quite swift, notably last week when prices reached down to the combination of September 2020 low at 942 and a dark blue optimized extension to the February to October 2021 head and shoulders top. That's currently at 939. Overhead, what we had previously seen as three bands of static support, where they now become resistances. First is at 1045 level, then a congestion between 1031 to 1033, followed by the October 2020 low at 1017. 3 weeks ago we saw penetration, and then 2 weeks ago a full break lower and stabilization below all of them, as well as through the support at 990, which is now resistance as well. Looking below, we have, as recently as last week, been testing the congestion based around the September 2020 low and a dark blue neckline extension. So far it's held up. However, much like my comments from last week, and I quote, "I'm not sure how good a support even that would be given the overhead ammunition pressing down on the market." These actions also have highlighted that the January to May action was a form of halfway hesitation, with the origin of this bearish halfway hesitation starting back in late November last year, and the potential for a move lower is down in the 980 zone, not very far away. End of quote. Well, prices have reached and exceeded the 980 zone last week, and holding last week and this around or under it. However, it would also be wise to look at better supports below. Hence 2 weeks ago I said, and I quote, "Looking even lower, we do start seeing some longer term supports enter the frame. We do start seeing some long-term supports enter the frame in the 895 to 910 zone. That's quite a way lower. I will discuss these more fully should we start approaching them." End of quote. Chicago soybean meal. Back in late February this year, down at the 326.90 level, the market consolidated after a significant fall that developed from the middle of November last year. This congestion was different compared to earlier ones, as we had crossing through it back then the extensions to the lower trend line, currently at 323.90, of the July to September 2021 descending triangle. I said 23 weeks ago, and I quote, "It's maybe nothing, but I'm minded after such a fall as we've seen since last November last year, that this may see some hesitation around the 327 to 325 zone. I'm not certain on that, but it is worth considering." End of quote. Well, prices utilised this extension to the descending triangle as a base back then and rallied back up, eventually ending up being capped. The double top formed over the month of May, with the additional help of the declining long moving average at the time, currently at 358.30, and the 50% Fibonacci line of the August 2020 to March 22 move at 390 even. The construction of this double top inevitably led to a move lower, down through the primary and secondary targets. But the key break lower happened at the third attempt, pushing down below the flatlining medium moving average, currently at 343.80, in the early to middle part of July. 2 weeks ago, we finally saw prices rise enough to fill in the significant changeover gap left behind between 335.90 to 319.5. However, this pullback up has not been sustained over the previously mentioned trendline extension, and last week we ended up not only being below this, but also down to levels last seen in August and September 2020. 2 weeks ago, I put forward a couple of features. The first was the bright red bearish pitchfork, Andrew's pitchfork, for the action between early July to early August. It has since developed such that it shows the very recent bearish angle of attack. The second is even more recent, is the weekly key reversal on down made 2 weeks ago, of which we have seen a limited follow-on lower to even weaker prices late last week. This left me last week wondering what next. Well, the drop was halted and turned up, a little unsurprisingly, by the band of congestion detailed in my daily chart between 282 even to 300 even, dating from April to August 2020. However, this does not mean this is the end of decline, just the end of a phase, if you like. I was also prompted last week to draw a mid-November 2023 to early May 2024 bearish shift pitchfork, highlighted in dark blue on my daily chart. You can see that the lows of last week were also testing the middle time, currently at 297.70, much as they did back in mid-July. It also showed that the market is likely to become squeezed between the sharply declining red upper time above, currently at 316.60, and the dark blue middle time below. This situation will resolve itself one way or another by the end of the first week of September, and in truth probably next week. Finally, last week I also took a look at the bigger picture here, and I'd like to put forward the possibility that the whole mid-November today action could be seen as a potential possible large bearish halfway hesitation. This would give a potential below down in the 253 even zone. In other words, down to levels last seen in 2016. I now only need to remind you of my words of 60 weeks ago and ever since, so well over a year ago, when I pointed out that Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duty came about at the end of 2023, and we have been living in the shadow of this pattern ever since. Chicago soybean oil. The market's drift of sideways to low this year has been down through various congestion bands. These were, and are, at 44.68 to 45.04, made up of the 2014 high at 45.04 and the May 23 low at 44.68, the nearby neckline extension of the October 2019 to February 2020 head and shoulders top, currently 44.61. Then the tight 43.80 to 43.94 zone, made up of the 50% absolute Fibonacci line at 43.80, and the April 2014 high at 43.94. Then the interesting congestion down at about 42.65, plus more recently congestion at 41.15 and the January 2021 low at 40.53. Prices had last week even looked down at the November 2020 high at 39.04 before a fairly free zone all the way down to the December 2020 low at 36.56. I mention all these because some 58 weeks ago and numerous times since I've spoken about a big descending wedge pattern that was on my daily chart back then. It is now high up off the top of my chart. I said the following, and I quote, "I would consider this descending wedge pattern may have lately morphed into a possible scallop pattern." End of quote. This was a big pattern idea, and the market's decline since autumn of last year fitted in with this. The expectations I voiced of eventually witnessing a fall down to the area of the May and June lows between 48 even to 46 even zone, which is where we have been until recently. I've often stated here how I was keeping a very, very close eye on this idea, as any significant breakdown below the 48 to 46 zone could signal the start of the rest of this move lower. 4 weeks ago, prices finally punched down through the neckline extension and at the same time started a definitive move lower below the previously mentioned 48 even to 46 even zone. It seems the market had come to a cusp and chosen the way lower. A new early July to date pattern has emerged, a purple highlighted bear channel, currently 35.21 to 40.44. All these actions seem to have secured some significant potentials on the downside. Thus, for the original big, much earlier mentioned 58-week-old big descending wedge pattern, we have the following opportunities on the downside. Primary target X would be in the 33.70 zone. The secondary, much harder to reach target X1, down in the 16.25 zone. Now, even a cursory examination of these two targets and one can deduce some notable points. The primary target at 33.70 is just above the 50% absolute Fibonacci line of 33.45 and is doable, especially with the addition of the monthly key reversal down we saw in July. The secondary target at 16.45 is so far down that calling it harder is a massive understatement. We would have to be down to levels not seen since May 2002, and I would think achieving that is a monumental task, and one right now that in all truth I could not endorse. This leaves this week's actions. We've seen a move up to the purple upper bear channel line and the January 2021 low, and a test of both of these. So far, these have held, but I watch with great interest just what the market will do with this resistance combination. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.